Have you ever wondered how financial analysts forecast the economy, industries, and companies? There are two main strategies they employ: the top-down and bottom-up approaches. Imagine you're standing on top of a tall building looking down at the city below. This bird's-eye view is akin to the top-down approach. Analysts start with a broad perspective, focusing first on the global economy. They take into account factors like interest rates, inflation, and GDP levels. Once they have a sense of the overall economic health, they identify promising industries and sectors. Finally, they zoom in further to analyze individual stocks within these sectors. The top-down approach is all about big-picture thinking. It's about identifying macro trends and finding the industries and stocks that are poised to benefit from these trends. Now, imagine you're standing on the street looking up at that tall building. This is the bottom-up approach. Analysts start at the ground level, focusing first on individual companies. They'll analyze a company's financial health, its competitive position, and its growth prospects. Only after they've identified promising companies do they look at the industry and the broader economy. The bottom-up approach is about detail-oriented analysis. It's about finding high-quality companies, regardless of the industry or the state of the economy. In contrast to the top-down approach, the bottom-up approach might unintentionally involve inconsistent assumptions. For instance, forecasts of the economy are of no use if done after company forecasts, as it's the expected cash inflows from the company's share that are used to determine the intrinsic value of a share. To summarize, the top-down approach starts with the macro, focusing first on the economy, then industries, and finally companies. The bottom-up approach, on the other hand, starts with the micro, focusing first on companies, then industries, and finally the economy. Both approaches offer unique perspectives and can be useful tools for investors. Each approach has its strengths and weaknesses, and the best choice often depends on an investor's personal style and goals. Whether you prefer to start with the big picture and work your way down, or start with the details and work your way up, understanding these approaches can help you make more informed investment decisions.